Hey there, if you've ever wondered what the stock market actually is and how people make or lose money with just a few clicks, this video is for you. We're gonna break it all down simply, clearly, and in plain English. No Wall Street nonsense. Stick around, because by the end of this video, you'll understand exactly how the stock market works, even if you're starting from zero. Let's dive in. So let's start with the basics. The stock market is basically a giant marketplace for businesses. Instead of buying bananas or shoes, you're buying ownership. Every time you buy a stock, you're actually buying a small piece of a company. That's why it's called a share, because you share in the ownership. Imagine if Apple had 1 billion shares, and you bought one. You now own 1 billionth of Apple. Small, but still ownership. The two biggest markets in the US are the New York Stock Exchange, NYSE, the Nasdaq. These are platforms where people all over the world buy and sell stocks all day long. It's mostly done online now, through brokers like Robinhood, eToro, Interactive Brokers, and others. When you buy a stock, you're betting that the company will do well and that your shares will become more valuable over time. So, how do stocks go up or down? Well, stock prices are all about demand and supply. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. This happens for a lot of reasons: a company's earnings report, market trends, news, politics, you name it. For example, if Apple releases a new iPhone, people might get excited and start buying Apple stock, which could cause the price to go up. But if something goes wrong, like a bad earnings report or a scandal, people might want to sell their shares, driving the price down. Now, the stock market isn't just about buying stocks and hoping they go up. There are two main ways people make money from stocks: capital gains and dividends. Capital gains happen when you sell a stock for more than you paid for it. For example, if you buy Apple stock at $100 and sell it for $150, you've made a $50 profit per share. That's capital gains. Dividends are another way to make money from stocks. Some companies pay their shareholders a portion of their profits regularly. It's like getting paid just for owning a stock. For example, if you own 100 shares of Coca-Cola, and they pay a $1 dividend per share, you get $100 every time they pay dividends. It's not guaranteed, but it can be a nice bonus. But there's a flip side. The stock market is risky. There's always a chance that the price of a stock can go down. So, how do you avoid losing all your money? Well, first, don't put all your eggs in one basket. This is called diversification. The more stocks you own from different industries, the less likely it is that all of them will lose value at the same time. Let's talk about risk for a minute. The stock market can seem like a roller coaster at times, with big ups and big downs. But here's the thing: over the long term, the stock market has historically gone up. Even though there are crashes, like the 2008 financial crisis or the 2020 COVID-19 crash, the market has always bounced back. That's why experts say that if you want to make money in the stock market, you should think long-term. Don't panic when things drop. Instead, focus on the long game. That's how the pros do it. Now, let's talk about how you can actually start investing in the stock market. It's pretty easy to get started. First, you need to open an account with a broker. A broker is just a middleman that lets you buy and sell stocks. Think of it like a bank, but instead of saving money, you're investing it in stocks. To open an account, you'll need to provide some basic information, like your name, address, and social security number. After that, you'll deposit money into your account. Once your account is funded, you can start buying stocks. But here's the kicker: you don't need a ton of money to get started. Some brokers let you buy fractional shares. That means you can buy a piece of a stock rather than a whole one. For example, if a share of Amazon costs $3,000 and you don't have that much, you can buy just $100 worth of Amazon stock. That's about 1/30th of a share. Pretty cool, right? But, before you start throwing money into random stocks, let's talk about how to pick the right stocks. There are two main approaches: fundamental analysis and technical analysis. Fundamental analysis is when you look at a company's financial health, things like its revenue, profit, debt, and growth potential. If the company is doing well and has a solid future, its stock price is likely to go up over time. Some people use things like P/E ratio, price-to-earnings ratio, to help decide if a stock is overvalued or undervalued. Technical analysis, on the other hand, is more about looking at past stock price movements to predict future price changes. You'll see a lot of graphs and charts, and some people swear by it. But, for most beginners, I'd say focus on fundamental analysis first. Before you buy any stock, it's also important to ask yourself one question: how much risk are you willing to take? Stocks can be volatile, and there are no guarantees. If you're okay with the ups and downs, and you're in it for the long haul, you can take on more risk. But if you're more conservative, you might want to look at safer stocks or even index funds. Speaking of index funds, if you don't want to pick individual stocks, index funds are a great way to invest. These are like baskets that hold lots of different stocks. For example, an S&P 500 index fund holds shares in the top 500 companies in the US. By investing in an index fund, you're getting exposure to a wide variety of companies, which can help reduce risk. Before you go, let's take a quick recap of the key takeaways. The stock market is a place where people buy and sell ownership in companies. Stock prices go up and down based on supply and demand. You can make money through capital gains and dividends. Diversification is key to reducing risk. Over the long term, the stock market has generally gone up. To invest, you need a broker account and can start with small amounts of money. Use fundamental analysis to pick solid stocks, and remember to consider your risk tolerance. If you take anything away from this video, it should be this: the stock market is a powerful tool, but it's important to approach it with patience, knowledge, and strategy. Don't expect to get rich overnight, and never invest money you can't afford to lose. Thanks for watching. If you learned something new, hit that like button and subscribe for more content on personal finance and investing. Leave any questions or thoughts you have in the comments below. See you in the next video.